All right, good to have you with us. Let's kick off our hour of programming with a look ahead for 2024 investing. Joining us here in studio is John Goldsmith. He's head of Canadian equities at Montrusco Bolton. John, it's great to see you.
Thanks for having me.
So we've got a few things going on. We talk endlessly about the state of the affairs in the economy, interest rate policy, what could be coming, what might not be coming, and then we're getting a flood of earnings right now. What's top of mind for you?
You know, it's perfect timing because, we start the day off with the PCE print in the U.S., which is the Fed's kind of preferred measure with regards to gauging inflation.
Which showed some encouraging signs?
Absolutely. So, the expectation, if we take a look at the beginning of the month when we had the jobs numbers and the payrolls, it was a little bit harder than expected. And then the CPI number mid-month, that was harder than expected. And then in Canada, we saw a slightly hotter number. The expectation is there that, there was a potential for this to be hotter as well. Why this is important is that if inflation is running harder than expected, remember the Fed's targeted goal, same thing for Bank of Canada, is 2% core or headline inflation numbers, so excluding energy and food prices. If that number's gearing towards 2%, they'll be more likely to cut. But if it's not, i.e. it's hotter than expected and above expectations, they're more likely to keep rates at a higher level. And why this is important is that the Fed dot plot, which is basically the median summary of the expectations of the members of the Fed, are expecting 3 cuts between now and the end of the year. Streets are already expecting about 5.7, close to 6, and which hasn't really changed that much since this morning.
And then I guess the other piece of data we got, there was some spending data, and I guess the trends there still show this, a resilient economy. We heard that earlier this week with GDP numbers in the U.S., which maybe it builds a case for that so-called soft landing. But to your point, maybe ultimately if inflation trends are improving and the economy is actually holding up relatively well in the U.S., then you don't have to see as dramatic a move in rate cuts as maybe the market had started to price in, or?
You got it. So to use a Grey's Anatomy type of analogy for those people that like medicine, for the period of time before COVID, basically you had a patient that needed defibrillators to kind of stay alive and, plugged in everywhere. Today, obviously, with interest rates where they are, you would have expected the economy to really hit a wall, and you haven't. GDP is really good. We just saw the numbers come out earlier this week, and the unemployment rate hasn't really budged up. In fact, it's close to like a 40-year low. So, reality is that the market, the U.S. economy, is able to survive and thrive with a much higher interest rate, which is good to have an interest rate cycle.
So, the Canadian economy, the U.S. economy, there are certain parallels because we are so close to one another. But how would you compare what's happening here in Canada versus the United States?
Canada's slightly weaker. Canada's slightly weaker for 2 reasons. Number one, typically the Canadian dollar is typically very correlated to oil. If you look at natural gas versus oil, you'll probably look forward like 10, 15, 20 years. Oil is in the period of getting transitioned out as whether it's renewables, electric vehicles, other sources of, call it power, will use to go to increase the demand for that. Natural gas, however, is a little bit different. And I heard, previously just before walking on with regards to the impact south of the border, what that can mean with regards to LNG. LNG will be natural gas will be the hydrocarbon of choice for the coming 10 to 20 years as a baseload capacity component. So that will be really important. But the key difference between U.S. and Canadian economies is on the personal spending side. Canadian mortgages, or the housing market, typically is a market that resets every 4 years because of the way the mortgages are set, versus in the U.S. you get a 30-year fixed, which means next year, not so much this year, but next year when you get those 2020 resets that came from ultra-low rates, you're potentially seeing a pretty significant headwind with regards to discretionary spending in Canada that you don't have as much in the U.S.
Do you think that those headlines of concern factor into what sometimes feels like skepticism in the market? Like I sit here every day and this is very anecdotal, but it feels like a bull market that people don't believe in. Because every time I look at the charts, and they're easier to access, let's say, with the U.S. But like I was looking at one this morning for the S&P 500, when you have moved out of a bear market and hit a new all-time high, and that is square on the nose where we are right now, you look 3, 5, 10 years out, with very few exceptions, you're looking at positive returns over the long term. There's a reason to be possibly excited as an equity investor, but you don't feel it in the market every day.
The proverbial climbing the wall of worry, right?
Yeah.
So, we've got interest rates that were ultra high. Last year, the expectations were that there was going to be a recession. Even today on Bloomberg, if I take a look on the economic forecast sheet, it looks like the probability of recession in the U.S. is 50 some odd %. So we're not in that camp. We think, once again, that this is very constructive for equity markets, provided the proviso here is you don't see a major spike in unemployment rate, you don't see a major fall off on GDP growth, whether it's Canada, Europe, US, it doesn't matter. So I think from that perspective, it's constructive. On the valuation multiples, yes, we're slightly higher multiples than we were this time last year. But the S&P 5, you strip away the Mag 7, you're around 17 times multiple, which has historically been like the 5 to 10 year average.
I'm glad you mentioned tech because of this obscure outperformance by the biggest technology companies. It takes up a lot of our conversation. Not just the Magnificent Seven, but if you're uncomfortable with what's happened with the Magnificent Seven, where else can you look in tech? We just mentioned in our newscast that Intel shares are getting hit in the pre-market. There are concerns about the outlook. All of a sudden, the narrative very quickly changed to, the turnaround story. Intel's been a really big laggard over the last decade. We talk endlessly about NVIDIA. This name, though, had a really nice move last year, and maybe that was because people were buying into a turnaround story. But at the end of the day, it just feels like we're going to have a lot of these stories to watch in the coming weeks because it wasn't just a story of NVIDIA rallying last year. You saw a lot of people putting money into technology, and now we get to hear what these companies actually say about the next 12 months.
There's an old saying, leaders lead, losers, who cares? And that's kind of the issue here. If I take a look at an Intel, there's a multitude of other tech stocks as well. I'm not saying all of people's tech exposure should be gravitating around the Mag 7 or around, say, a Shopify and Constellation in Canada.
Like people liked IBM yesterday.
Well, exactly. But this is the thing is there's a reason why they are where they are. And if you can't grow your business, it's all about market share. If you can't grow that business, the only thing you can do at the end of the day is cut costs. You can't cut your way to prosperity. I think that's a lot of the issues here is that if the thought process is, let me buy the laggards in tech from last year and those will become the outperformers, that in itself is not a thesis.
Yeah, because the earnings growth component of valuing these companies over the next 5, 6 years, it helps if there's a lot of growth at the top line, which flows down to the bottom line. Seems like one of the reasons people like NVIDIA.